So tonight, what we want to do is get ready for paper one. It's really the only thing you need to work on here. I'm going to warn you, there are certain places a good chunk of the class does really badly on, and I don't want this class to do that. So I want you to be able to read between the lines. It's a good thing to start with the rubric. So the rubric, this is not a summary of the article. There's more to it than that. The article is the basis, but we're going to draw more out of it than just what's in the article. And I used the 2001 just because it was just the best he wrote it, and it was after such a tragic event. But you can definitely get his more recent annual reports, and he does talk about float quite a bit. So you start off with the definition. We said his definition is pretty weak, but he implies a greater definition. We'll talk about that. What is the cost of float? He definitely has that. I want you in your paper, put this in your notes. When you're talking about the cost of float, I definitely want you to use something called the combined ratio, which he doesn't use in his paper. So you have to know what the combined ratio is. He's essentially using the combined ratio without referencing it, but I want you to be using good property and casualty insurance jargon. And then he says there's three things he learned about controlling the cost of load. So he says, what is the cost of load? Okay, fine. In 2001, our cost of load was really, really high. What went wrong? He says he learned three things. I'm going to say he learned six things because this list is even more involved than what it appears. So again, you're not summarizing his article. You're pulling out what we're trying to get from class. And then on the sixth one, I'm asking for a little more discussion on this experience versus exposure, which I think is actually one of the most important things he talks about in this. It somewhat goes back to the top, some of the ones in the top five. It's a little bit of redundancy, but he does it in a way I think is really, really important. Well, it's really important when we talk about pricing products and accepting risk. So how did the property and casualty industry, when they accept your risk, what do they call that? I don't know if you ever heard the term. They say they write the risk, WRITE, they write the risk. So when you hear the insurance industry talk about writing risk or writing policies, they're accepting risk. I don't know why they call it writing, but that's what they call it. And then his page 10, I just think is unusual. It just kind of comes out of left field where it seems to me you could make an argument. I'm not going to say you're going to make the argument. You might not have the problem with it. You could make the argument that is it really consistent with this list of six things? And then I want to go out there and find something on the internet related to this that adds something to it. So not just repeat it. So you can definitely do Warren Buffett and insurance float and all kinds of things will come up. What I want you to do is try to find something unique in here. I'll give you some hints of some things you could search for that are out there that are pretty interesting. Things like the underwriting cycle is interesting. You could certainly talk about specific types of risk that are interesting related to this. So when you're talking about experience versus exposure, you're giving examples. One thing you could do to do that other is go in more detail on one of those examples, whether it's earthquake risk or cybersecurity risk or terrorist risk, whatever those risks are that you want to use in your example, and just go out and find some more data on that. There's some easy ways to try to add to that extra 10%. But keep this in mind. Where students lose most of the points is on 6 and the examples. These two lines, that's 20% of the paper, and there's some students get almost no credit on that. Why? Because it's not so blatantly in his paper. You have to somewhat draw it out. It does amaze me. Some students seem to write this paper without looking at the rubric. So y'all all know the rubric's there. Is that true? The rubric's there, you know, to reference it. It's at the bottom of the paper discussion. So let's actually go through his article and then we'll jump around a little bit. This is more extensive than his other annual reports because 2001 was so unique. There have been some insurance years that were worse in 2001, but not necessarily for Berkshire Hathaway, for other insurance companies, because they don't really have as much risk in some of the other risks, such as homeowners. So they have some, but not nearly as much as other companies. This was just a really big event for them. So what happened to Berkshire Hathaway? So the horrible event of the Twin Towers being destroyed, and you think that's property risk, but a big risk that he had was workers' comp. So he had people that lost their lives, and workers' comp had to pay their families as workers. And their idea was they didn't have much risk because they were insuring all these different companies. And it's amazing no one stopped to ask what happens if all those different companies are all in the same two buildings. Had anything ever happened to the towers before 2001? Y'all are too young to remember. Y'all remember? Have anybody seen it in the news? So there was a bombing at the towers in the parking lot about a couple years before 9/11. So they'd had someone attacking before. It is a pretty important piece of property from the financial center, US. Anyone who doesn't like the US, it wouldn't be a bad property to go after. But essentially, they said, hey, you know what? It's all these different employers. The chance that something would hit all of them at the same time is just not going to happen. And then suddenly they had something that was just unthinkable. So that's the context of why he's writing this. He wants to explain to his stockholders why they lost so much money in 2001. And it was related to this. And he wants to explain, not that, oh, don't worry about it, we got this covered. Instead, he wants to say, hey, we made a mistake. Let me explain what mistake we made, and we won't make it again. And then you get to page 10 and ask, well, maybe they didn't learn, but we'll see. Did you know that Berkshire Hathaway is primarily insurance? Yeah, they have other things like Dairy Queen and Fruit of the Loom and Northern, whatever that railroad is. But their primary business is insurance. And you think Geico, some of y'all might have Geico, but actually their biggest insurance are their reinsurers. The reinsurers are these insurance companies that insure other insurance companies. And they have pretty high deductibles. So the deductible on your auto insurance might be $500. Berkshire Hathaway's deductibles are like $2 billion, $3 billion. They're covering things at the extreme. So most of the time they don't pay anything, but every once in a while a really big event happens and they cover it. One thing you could, and Sophia brought this up, a really famous reinsurer is, and I don't know how to spell it, Lloyd's of London. I don't know if that will get me to it. Is that their homepage? Does that look like it? So they're very similar. So you might find something there that would be interesting, either for this paper one, that extra 10%, or for your paper topic for the second paper. Lloyd's of London, they have a really famous building. If I go to, next time I go to UK, I've never been to the UK. When I go, I would definitely want to visit their building. It's really, really famous, really beautiful building, very open. And they have an insights section. So there is a good website there, very interesting. But they're another reinsurer, just like Berkshire Hathaway. They're unique in the fact that they don't have limited liabilities. Most corporations are, in the US, corporations have limited liabilities. So if you invest in NVIDIA, if you invest $10,000 in NVIDIA, what's your worst case scenario? What's the most you could lose? $10,000. Lloyd's of London is not like that. You invest 300,000 in Lloyd's of London and things go badly, they're going to call you up and say, you need to send us more money. It doesn't have limited liability. So they better get risk right because they have a lot more. So they're an interesting firm that does something similar. I don't know if they lost money in 9/11. It would be interesting. My guess is they probably had some exposure to that. But that's what a reinsurer is. There's these big companies that essentially take the tail risk of an insurance company and take that over for them. These extreme events. When I was at USAA, we bought a lot of reinsurance. I have had the reinsurance actuary from USA speak to this class the last two times. I don't know if I'm going to get them this time or not. We'll see. He is the catastrophe expert out there. He bought all of USA's reinsurance, and USA bought a lot of reinsurance because they have a lot of hurricane risk and earthquake risk. So reinsurer says, USA, if you have $2 billion in earthquake risk and it happens, you're on the hook for 2 billion, but after 2 billion, we'll pay everything over that. So they don't come in until the extreme. So understanding that is their business. We're not talking about Geico here. We're talking about their reinsurance. Gen Re is their main reinsurance company. But insurance is their biggest business, especially reinsurance. So he says the key for understanding insurance is float, its cost, and what it looks like going forward. Is this a good business to be in or a bad business to be in? So the amount of float. Now I want on your paper to state this. He doesn't clearly state it, but I'm going to tell you what he's saying. He's very, very clear. The amount of float is the reserves on their balance sheet. You can even see it on page 7. Right here, he's saying this is their float. This is actually their loss reserves on their balance sheet. That's what he calls float. Anybody know what a loss reserve is? Well, first of all, is it an asset or liability? Well, he's saying it creates an asset, but is it an asset or liability? So a reserve this is money they're expecting to pay out that they haven't paid out yet. Does that sound like an asset or liability? You owe someone money, does that sound like an asset or liability? So liabilities. So if you look at their balance sheet, they have something called reserves. It's on the balance sheet. A reserve is just a liability of money they expect to pay their customers they haven't paid yet. Here's Geico, kind of growing about 200 million a year. Here's Gen Re. This Gen Re is their big reinsurance company. That's what the Re stands for, is reinsurance. Notice what happened to the reserves. In 2001, they jumped $4 billion. Their other reinsurance jumped another $3 billion. So their reserves jumped about $8 billion, and almost all of that was the reinsurance side, and almost all of that jump was due to 9/11. So that gives you some sense when you're trying to define reserves, we're talking about a liability. When you say it's an asset, I understand why it can be confusing. He's saying float is a liability. It's like debt, but it's money you haven't paid out yet. So that means you have money today, you have an asset because you haven't paid the reserves yet. So there is an asset side to it, but the float is the liability side. What you do with the money before you pay it out, that's an asset side of it, but the float is the liability side. It's not debt, but he talks about it as if it were debt. All liabilities are essentially debt, right? Accounts payable, salaries payable, debt, anything you have that you owe someone money in the future, that is essentially a debt. So when he talks about the definition of float, he is real specific. Float is the reserves on his balance sheet. He's saying we had $36 billion in float in 2001. A huge jump. Why? Because of 9/11. So the amount, its cost, we'll talk about the cost. That's where I want you to bring in the combined ratio. And then he's going to talk about, it's not so much the factors going forward, but it's really what he learned in 9/11 that he doesn't want to repeat again so he can control that cost of the float. All right, so let's start off with the definition of float. There's several aspects to it. His definition will not work for your paper. You can put it in there, but it's too simple. It's money we hold but don't own. So if you have someone's money and it's not yours, that's what he's saying float is. So what's key with float? So make sure in your notes, really key with float is this idea of a time delay. It's a timing issue. Why do we have float? Because float arises because premiums are paid or received before losses are paid. You pay your auto insurance premium. 6 months later, 9 months later, you might have an accident. They'll pay you for that 6, 9 months. They have your money. Now you may not get anything, but on average, they're going to pay out about 70%. So you give them $1,000, everybody else gives them $1,000. And I don't know if why is this AI trying to help me? So everybody pays their money. You may not get anything, but on average, they're going to pay out 70% of that money, but they're not going to do it immediately. They're going to do it 6, 9 months, a year later. So that's really important to your definition of float, is this difference between when premiums are received and losses are paid. And that interval can be quite extensive. We're going to talk about, oh, I forgot the name of it, asbestos. Asbestos is a very, very, very long insurance product. People might have been exposed to asbestos in the 70s. They get diagnosed with cancer in 2020. I mean, it can be 50, 60, 70 years. Anybody know what that's called? You ever heard long tail lines? Use that in an interview with an insurance company. They'd be really impressed. There's short tail lines and long tail lines. Asbestos is a long tail line. It's a big difference between when you take on the insurance and when you may have to pay out. You may pay out 50 years later. What about auto physical damage? Does that sound like a long tail line or a short tail line? Do you think it's going to take 10, 20 years for them to pay your auto insurance claim? I mean, pretty fast. Auto insurance is a very short tail line. Homeowners is maybe a little bit longer because it takes longer to build houses than to replace cars. The liability side can be longer. If you have an auto accident and you injure somebody, you may have to pay him an income for life. That can extend over 50 years. So that's possible. Most insurance companies get that off their books and sell it off to somebody else. But float is not the same for all products. I'd be impressed if you had in the paper talk about, it can differ between short tail lines and long tail lines and give some examples. That could be your 10% extra credit. You could say P&C insurance, long tail versus short tail lines, and see what comes up. Put it in Chat GPT, see if Chat GPT knows anything. You can't always trust them, but sometimes you can. Long-term lines involve claims that make several years to settle. Malpractice, we'll talk about malpractice. That's on the doctor side. Short-term lines involve claims that resolve really quickly, such as health or auto coverage. And they talk about the timing, the gap between premiums are collected and when claims need to be paid. So yeah, there may be other stuff out there to be interesting. There's even YouTube videos out there. You can use a YouTube video for your that 10% and just summarize what's in the video. That works as well. All right, so float is money you have that you don't own. The exact number is not a subjective number. It's a number you can find on the balance sheet. He's saying it's the reserves. Why do they have this reserve? It's because they've collected money, premiums from their customers, but they haven't paid the claims yet. It's going to take some time. Think about rebuilding the Twin Towers. That can take decades. Paying people their workers' comp claim can take some time because there's a lot of paperwork. So there can be quite a bit of delay. What's another definition of float? Well, you can use the concept of debt. You can think of it as a debt. It's not exactly a debt, but it's very similar to that. So what's the downside of that is that the premiums may not be as large as what they're going to pay out. So let's talk about the combined ratio real quickly here. So when you're talking about the cost of float, he's specifically talking about the combined ratio. And we talked about this last class. Combined ratio is your outflow divided by your inflow. Combined ratio has 3 pieces to it. There's a loss ratio, an LAE ratio, and expense ratio. The loss ratio is your claims divided by your premiums. So that's the money that goes to you as the policyholder, directly to you. What did they pay you? So if it's health insurance, it's what they paid your doctor, they paid the hospital. It's auto insurance, is what they paid to fix your car. The LAE ratio is the loss adjustment expenses divided by premiums. Those are the expenses the insurance company incurs to settle your claim. It's the claims adjusters, it's the people coming out to look at your property. And then the expense ratio is all other expenses divided by premiums. You only get this piece, the claims. You don't get the rest of that. We'll look at this a little bit later. I might be able to show you. Let's see if I can find it. I want to update it. But I can show you some old data. Yeah, I may not have done it last semester. Let's see if I did it the previous semester. Yeah, I'll bring it in, but well, here it is. Let's see if I can show you this. This would be really old data. Let's look at, I can't show you Berkshire Hathaway. I can't show you Geico because it's part of Berkshire Hathaway, but I can show you, let's try Allstate or Progressive. Progressive, interesting because they primarily do auto. They started getting the homeowners, but they primarily do auto. So I only go through 2023, but here's their combined ratio. The last 3 years, 95.3, 95.8, 94.9. That's their combined ratio. So what does that mean? You give them $100 in premiums and they pay out how much? They pay out about $95.30 or $94.90. How much of that goes to you? Well, that's the loss ratio. This is all three of them combined. All right. Are they making money on their underwriting or are they losing money? If it's below 100, they're making money. What does Warren Buffett say? If the combined ratio is below 100, he's saying, I'm actually getting paid to hold other people's money. He's saying Progressive is actually paying -5% or -4% to borrow money. That's a pretty good debt rate, isn't it? You could borrow money at -4%, you'd borrow a lot of money. That's why he loves insurance. What about this firm here? This is Allstate. Allstate had a really good year in 2020. Look at that. 87.6. That's really, really good. But look at the last 2 years. Why is Allstate doing badly when Progressive is doing well? What does Allstate do that Progressive doesn't really do? Homeowner side, yeah. And I don't know what happened in 2022, 2023, but it wasn't a good year for Allstate. In fact, it was their worst year of the last very, very, very many of them. There's a bad year. That might have been Katrina or something. Huh? Yeah, 2011. I can't remember my hurricanes. I get my years mixed up. Allstate has struggled here the last few years. But here's the expense ratios. So about, and those are pretty high. They've come down. So which line was Allstate? Okay, line 6. I got to remember that. So just think about this. About a fifth of what you pay the insurance company just goes to pay their expenses. All right, very similar to what we talked about life insurance class on health insurance. When you use health insurance, about 1/5 of that's just going to go to expenses. So that means if you can pay out of pocket, it's going to save you a lot of money. Just the fact that we use insurance raises prices 25% because you got to pay the insurance company. All right. So you can see Geico. Now, a few years ago, USA had a big restructuring, probably before y'all remember. Bob Davis laid off about a quarter to a fifth of USA's employees. Why was that? Well, because Geico's, I don't have Geico in here. Geico's expense ratio was about 18%, Progressive's was about 18%, and USA's was 28, 29%. There was something wrong with USA's expenses. We were spending a whole lot more money than our competitors. And Bob Davis said, no, we can't compete. If we're spending, you give me $100 and we're spending an extra $10 just on expenses. How are we possibly going to compete with Geico and Progressive? And Geico and Progressive really did change the industry. They brought these expense ratios down. I can't show you USA because it's not a public company. Here's the loss ratios. This is the money that actually comes to you. You can see Allstate pretty high versus Geico. So if you buy, versus Progressive, you buy insurance from Progressive, you give them $100, about $77, $78 of that will come back to you in claims. And then the rest is going to go to expenses and to LAE. There are some bizarre firms out there. I don't know why it keeps doing that. See if I can find one. Like here, look at that loss ratio. You give them $100, and on average, they pay you $5. Where's the other $95? Anybody want to guess what that insurance is? It's an insurance I really dislike very much. Any guesses? Well, title. Yeah, I don't know. You have to show me a company like that that does that. There's possible. You mean like cyber security or something? Oh, like Apple. I don't think that's going to show up in here. So I don't buy Apple insurance on my phone, even though I probably should last year when I dropped it. My guess is because I know the equation, right? You pay them $100, they're on average going to give you back, so that one probably is that's one you could probably research. I don't know if they do that through an insurance company if they self-insure, but that would be interesting. But yeah, these are the title insurers. When you buy title insurance, they hardly ever pay out a claim, and when they do, it's just not that much. So we'll talk about title insurance much more later. How do you get negative numbers? That I can't tell you. I don't know what this company's doing. Doesn't look like a very profitable firm. No telling who it is. Oh, MBIA. Y'all know who that is. So 2008, we had the mortgage crisis. MBIA, their insurance is they insure mortgages. And so they blow up when the housing market's blowing up. So if we could show 2008 for them, it would look pretty horrendous. But that's MBIA. But the combined ratio is a good number to know if you're going in interviews with insurance companies, knowing the combined ratios. So someone off the top of your head, what are the three pieces? The loss ratio, LAE ratio, expense ratio. Which part of those do you get? You just get the loss ratio, which is 70, 75%. The other 20, 25% is going to go pay expenses. We also have the profit in there as well, but so that's the industry. So when he's talking about the cost of insurance, it's not anywhere in his paper in those words. He doesn't use the word combined ratio, but it's certainly implied. He calls it an underwriting loss. Another way to say underwriting loss is the combined ratio above 100. It means your outflow is greater than your inflow. What is not in the underwriting loss is the investment side. It excludes the investment income. This is just the underwriting side. So you hear underwriting, they're just talking about the property casualty business, not the investment side. Now, why does he like insurance? Because he says, when I do insurance, I'm essentially borrowing money from my policyholders. If doing Geico and doing Gen Re, if that cost of float is lower than what I have to pay if I borrowed money on the market, then it's a good business. Well, obviously, if your combined ratio is below 100, that's pretty cheap financing, and that's the way he views it. I can go out to the market and borrow money and buy all these businesses, Apple and Fruit of the Loom and Dairy Queen, or I can be in the insurance business and I'll use my insurance company's customers' money before I have to pay them. I'll use that to invest. And if they're cheaper than borrowing in the market, then that's a good business. So essentially what Warren Buffett is saying, if you're a Geico and policyholder, he doesn't consider you a customer, he considers you a cheap source of debt, cheap source of funding. So in insurance, this is a pretty important phrase. An insurance business has value if its cost of float over time, this is an important concept as well, is less than it could get if it borrowed money somewhere else. And he says for Berkshire Hathaway, for Geico, for Gen Re, that has been true for the longest time, except for 2001, where they had stuff just not work out. So historically, it's gotten its float at a very low cost. Indeed, it's been less than zero in about half the years. What is he saying? About half the years, their combined ratio was below 100. That's what he's saying. He doesn't actually say that, but that's what he's saying. He says, we've actually been paid for holding other people's money. The last few years, it's been too high, and in 2001, it was terrible. And then he brings this table in and he doesn't tell you what it is. Well, he kind of does here. Loss reserves, what's a loss reserve? That's the reserve for the loss piece, the claims. The LAE reserve, that's how much they set up in reserves to pay their adjusters and other people. They haven't paid them yet, that they know they're going to be sending them out. And then there's these other things we don't really need. The unearned premium we'll talk about a little bit later. So I don't need this formula. I just generically what I want is what he says float are those reserves on the balance sheet. It's that liability, those things they're going to have to pay out, whether it's to their policyholders in claims or their employees as loss adjustment expenses. Those are the things he counts as float. And you think Geico is a big part of Berkshire Hathaway, but the reinsurance is quite huge. Now, Geico is auto insurance, which is a very short tail line, which means you don't have as much reserves there because they get paid out pretty fast. So that gives you a little difference, but this is a big part of their business. Gen Re and their other reinsurance. It's a huge part of their business. And so that's really where his issue is. I doubt he's ever had a year where Geico really caused him major problems. Auto insurance is a pretty stable, predictable business. So he said their cost of float in 2000 was 6%. What is he saying? He's saying their combined ratio was what? 106. Right? If he's saying their cost of float 6%, he means their combined ratio was 106. He's being a little sloppy in the numbers. Now, I know y'all can do this next one. In 2001, it was 12.8. So what was their combined ratio in 2001? 112.8. All right. The worst year in cost of float since 1984, and a result to a significant degree explain the next. So he's going to explain what happened. Right. Are y'all comfortable with combined ratios? Now, Geico is interesting. If you go back, what does the G for Geico stand for? It's government something, right? It's kind of like USAA. What does the USAA stand for? Well, now it stands for USAA because they changed their name, but it used to be United Services Automobile Association. But now it's not that. It's USAA. They just get rid of all those words. Geico is kind of like that. Geico used to stand for Government Employees Insurance Company or something. And now it insures everybody, not just government employees. So Geico is very stable business. Probably has never had a combined ratio above 100 in its history. We can't see that because we don't have that data. But you can look at Progressive and just see that Progressive is pretty consistently even below 95 pretty consistently. Very stable business. Very predictable. But then you throw homeowners in and what happens? Suddenly it gets a lot more volatile. Reinsurance companies, they tend to be really low combined ratios for a few years, and then they shoot up a really big year, and then they come back down. That's really important. We're going to bring that out when we talk about his factors. All right. He says cost of flow to 4%, a combined ratio of 104 is fine. That wouldn't be good for auto insurance, but he's comfortable with that with his business. All right. Any questions up to there? So we've got float defined. We got cost of float defined. So you got the first 20% of the paper. Any comments, questions? If you're not sure, I'd write that part of the paper and come bring it to me, and make sure you didn't leave something major out, because you see how you would do really badly if you only use this article. There's a lot of stuff in between the lines we need to pull out because he's being a little overly summarizing. Okay. What is underwriting? So you see the word underwriting, that just means you're selling risk protection to customers. Underwriting is, we'll talk about it as a career. You could be an underwriter. It pays well. It's a good job. It pays, 60, 70,000 to start. If I were an actuary and hadn't finished the exams, I would probably apply for a job as an underwriter. It's a great way to start. They love actuaries because they work a lot with the actuaries, and they have no trouble with an actuary being an underwriter, knowing they're taking exams and want to move over to the actuarial side because it's going to be great for the company. But the underwriting is really assessing the risk, what risks they want to take on. And so he's saying, what's the principle of those risks that we're taking on that we messed up in 2001? So what counts in the business is underwriting discipline. He says 3 principles. We've got 6. So let's see if we can figure these out. And I'll try to match his up with yours. Put these into your own words when you summarize them. You can quote him, but put it in your own words. So he says they accept only those risks they can properly evaluate. If you look in my rubric, number 3, you'll see that able to evaluate. You need to bring into that, what does able to evaluate mean? He doesn't say this, but I want it in your answer. That has to do with frequency and severity. Those are the 2 main concepts. Frequency is the probability that something will happen. Severity is, if it happens, how much did you lose? So if you can't assess both of them, you might say, well, I know we're going to have an earthquake, a major earthquake every 7 years. I just don't know how big it's going to be. So there you know frequency, but you don't know anything about severity. Or you say, wow, if we have a 10 earthquake on the Richter scale, well, we're going to lose $10 billion. I just have no idea what probability that is. Then you know severity, but you don't know frequency. So you have to know both of these. You're able to evaluate it. You have expertise on both frequency and severity. All right, staying with their circular competence. All right, that's 1. Then he says, after that, including remote loss possibilities, they expect a profit. All right, that's the second one. I put it as the first one. You don't have to go in my order. One really key on expected profit. Make sure you get this in your notes because I do count off if you leave it out. I do not believe he's saying you're going to be profitable every year. That's practically impossible in the reinsurance business. You're going to have a bad year in reinsurance. What I believe he's saying, he may disagree with me if he were here, I think he means over time, it's a profitable business. You might fluctuate around, have a few lost years, but over time it's profitable. Mainly because it's just not possible to make money in insurance every single year because you're going to have bad years, especially when you're doing reinsurance. Geico, maybe you could say Geico makes money every single year. All right, so make sure in your notes, expect a profit, talk about the timing there, not necessarily every single year, but over the life of the product. Now, why is that important? Well, a good example is homeowners insurance. think it was the Northridge earthquake in California. That was before y'all were born. That was an interesting one. If I got Northridge right, I think that was the one that hit the World Series, but I can't. There's two earthquakes. I get them mixed up. But there was a major earthquake in California. California was built to withstand earthquakes. This is good, and it worked. The buildings didn't fall, and people say, "Well, this is really good." We have all these protected buildings, and then the losses came in, and the insurance company was like, "My word, we lost a fortune." And what they discovered is that they lost more in that 1 year than their premiums the previous 30 years. So in 1 year, they wiped out all of their profits and revenues for all those previous 30 years. That is not expected profit. If you can wipe out 30, 40 years in 1 year. So what did they get wrong? Well, the buildings were built to withstand the earthquake. And then the adjuster came in and looked at the building and said, yeah, the building didn't fall, didn't kill people, but it's in such bad shape, we got to tear the building down and rebuild it. Like, oh, okay, so that's a little bit higher expense than we were expecting. So that one event. So that's why he said, you got to look at it in terms of even remote scenarios, because if one remote scenario can wipe out 30 years, that's not a business you want to be in. So you expect a profit over time. You can have one kind of bad year, but you can have 1 year that wipes out the previous 30. All right, there's the second one. Yeah, I got the first. What is the first one? You're able to what? The value of the risk in terms of what two things? Frequency severity. Second thing is expect a profit over time, not necessarily in every year. All right, we're still on number one. So the next thing he says, they ignore market share considerations. Oh, I can never remember the word sanguine. I get sanguine and blithe mixed up. One of them means you don't care. The other one means you're happy. Yeah, so sanguine is you're actually happy about it. You're actually happy about losing market share. Okay, what does blithe mean then? Yeah, so sanguine is you're happy about it, blithe is you don't care. He's not saying you can be blithe about losing market share. He's actually saying be sanguine. You're actually happy about it. Does that make sense? Can anybody be happy they're losing market share? Do you think he picked sanguine correctly, or did he think maybe he didn't know what it meant? So, but be sanguine about losing business to competitors if they're pricing their policies incorrectly. He said, let them have it. If people want to go from Geico to State Farm because State Farm is charging 10% too little, let them go. They'll learn their lesson. State Farm will lose a lot of money, have to raise their prices. They'll come back to us eventually. I don't know if sanguine's really what he meant. I probably would have said they're blithe about losing market share, but they ignore. I mean, is that really true? Is he going to ignore if they're losing 10, 20% of their customers? Oh, let's just ignore that. But that's essentially what he's saying there. So that's the third thing is if you can't get that expectancy of profit because the competition is causing you to reduce your prices to a level that doesn't make sense, then hey, lose market share. So if I'm profitable, willing to lose market share, he even says be happy about losing market share. Now in Geico, he can say that because his expense ratio is so low. Progressive, their expense ratio is so low. So USA was way up there, State Farm was way up there, Allstate was way up there, and these competitors, Geico and Progressive, come in very trim, very lean. The difference with Progressive and Geico was they spent a lot more on marketing than other companies did. I've noticed USA spending more on marketing today than they used to, but their expense ratio is much lower. So he kind of knows with Geico and probably even with the reinsurance company, he knows if a competitor is charging less, they're doing something wrong because he knows his expenses are lower. So he knows he has a competitive advantage to start with, and because of that, he has great confidence that he's going to be competitive, or his competitors are simply charging the wrong price. All right, so there's three right in that first one. Make sure you can evaluate the risk in terms of frequency and severity. After you do that, even looking at remote loss, you expect a profit over time. And if you can't do that because competition is pulling you down, then be happy about losing market share. All right, you see why you can't just use his list. There's three right there all together. I don't know why you didn't separate it out. All right, the next one has to do with the aggregation of loss and correlation. So this one's pretty important to what happened to him in 9/11. They limit their best business so they will suffer no aggregation of losses from a single event or from related events that will threaten their solvency. They avoid remote loss possibilities or losses that may aggregate. There in your answer here, you got to make sure you talk about the word correlation, unexpected correlation. I talked about it in my risk management class last night. I called it contagion. You have things that are unrelated, but then you have this extreme event where suddenly unrelated things all become related. And that's what he's talking about, unexpected correlations. He says it better than anybody. I don't know if he wrote this, but I love this phrase. It's very alliterative. They ceaselessly search for possible correlation among seemingly unrelated risk. Ceaselessly search. It's a great phrase. We're saying don't just assume they're unrelated. Think of ways they could become related. Two 2008 is a good example. The rating agencies that said, you know what, the U.S. housing market's very diverse. So as long as you have exposure to the U.S. housing market, but it's spread out all 50 states, you don't have to worry about it. It's very well diversified. And what are they assuming? There's no way all the housing markets in the United States would suddenly all become correlated to each other. If California is struggling, Texas is doing okay. And then what happened in 2008? The entire U.S. housing market and the toppled all together. And that's what he's saying here. Now, what is he talking about with 9/11? This is his thing where he had all these employers in one building, and they never thought that all those employers could have an event that hit them all at once, even though it seems pretty obvious after the fact, doesn't it? You got 50 employers in the towers. Someone would think, well, they're all in the same building, and this is a building that's been attacked just a couple of years before. Maybe that is an issue we should be concerned about. Maybe we should reinsure some of those risks or pass it on to another company. So he said they did not do a good job of that. Ceaselessly search for possible correlation. Make sure correlation is in your answer, in your discussion there. Avoid remote loss possibilities or that aggregate. That aggregation is talking about that correlation. It might be 5 events and you don't think any one of them would happen with the other one, and suddenly all 5 happen together because something else is related that's causing them all to happen. That's that contagion effect. Right, there's just one there, so but you need to add in that concept of correlation. Very, very important. The next one is a give me. I don't really care what you do this next one. I'm not saying it's not important. I think it's very important, but it's true for every business. So I don't really see it related to this particular one. Just throw it in, you get full credit, right? I don't even really care how you throw it in, just reword that. He says, avoid business with immoral people. So that's probably true with Walmart and Costco and PepsiCo and everybody else. So don't do business with immoral people. I'm not really sure what it has to do with 9/11. I don't think he lost money because he was dealing with immoral people. His customers were as much of a victim as his business got hurt. So just throw that one in. That one's a piece of cake. All right, can you remember them without looking? Number one,
Frequency and severity.
be able to evaluate frequency and severity. Expect a profit every year over time. That's including what kind of things? Remote loss. The third one, I don't know if I can remember. Yeah, happily walk away from market share if your competitors are charging bad prices. The fourth one, Avoid what? Loss. And make sure you have what in that answer? Correlation. Ceaselessly search for those correlations you weren't expecting. And the fifth one, pretty easy, avoid business with unethical people. Now, there is another one. I have it in their list. He kind of throws it in here. And it's this concept of exposure versus experience. So he says the industry made a fundamental underwriting mistake. Remember, underwriting is what risks they take on. They made a mistake of taking on risks they shouldn't have by focusing on experience. What is experience? Experience is your actual loss history historical. Your actual losses that you have historically. Now, some students struggle with exposure. What is exposure? Exposure is what you have, what risk you have right now. Will they behave like your historical risk? Maybe, maybe not. But exposure is what you've actually promised to do going forward. Experience, you can't change that. That's already happened. That's what you've done in the past. Exposure is what you have right now that you promised to do something about. Now, obviously, he brings up specifically terrorism risk. And he actually says terrorism risk was a risk they were insuring where they weren't getting paid any premium for it at all. They're essentially assuming zero. And why is that? How much experience did they have for terrorism risk in 2000? Essentially zero in the United States. Now, we did have the Oklahoma City, which was a horrible event. So that one was, you could classify that as a terrorist event. But for Berkshire Hathaway, they had not seen any terrorism events. So their experience said zero. If your experience says zero, does that mean your exposure is zero? And he's saying that's kind of what we assume because we're charging zero, but we should have looked at the exposure and thought a little more broadly. So make sure you have a good definition of experience versus exposure. Experience is the easier one. It's your actual frequency and severity from all your prior years, what you learned from that. Does that mean you ignore experience? Well, no, you've got to look at experience. It's a highly useful starting point in underwriting. It's important for insurers in California to know how many quakes in the state during the past century, Register 6 or higher. That's useful to know. Does that mean that's going to be the same experience going forward? Well, even if you don't think it is, you still want to know that number because that gives you a starting point. This information will not tell you exactly the probability, but it has its utility, especially if you're writing a large policy. There's one of their other reinsurers, National Indemnity. So earthquakes is interesting because people are saying we still have the big one coming in California. How much history do we have with earthquakes? They have some history that goes back further. The challenge they have with experience and exposure, especially in California and Florida, is they may have some data on hurricanes and earthquakes back 500 years, 600 years. The problem is no one was living there. And so now people are living with all these expensive properties. So it's a very different, it's hard to know what historical events would have done given what's sitting there on those properties today. But they do have some data. We do have some sense of what's going to happen historically. He says there are times, though, where experience as a guide, not only could it be useful, it could actually be dangerous. It may actually cause you to take on a risk you shouldn't take on just because something's never happened before. He's essentially saying the fact that something's never happened is not proof that it will not happen. All right, we'll talk about in our risk management class. We're going to talk about Taleb. Taleb has the kind of humorous thing of saying he can prove George W. Bush is immortal. You say, how can you prove that? He says, well, I've seen him on TV thousands of times and he's never died once. So he's proven George W. Bush is that good proof that George W. Bush is immortal? It's a lot of experience, right? Thousands of days. He's never died once. And he's saying that sounds silly, but he says we do that in finance all the time. It's never happened before, so it can't happen. And he's saying no, just because something's never happened before, and so you price zero, you need to think much more broadly than that and assumes something could change in the future. He gives an example. All right, so here's the part where people lose the most points on this example. So I have it down here in the notes somewhere. I have it up here. And I don't know why students miss this. I think part of the problem is some students start on the paper like 3 or 4 weeks from now, and they forget everything we talked about in class. So if you start on the paper now, you'll remember this. He doesn't say this in the paper, he hints at it, but I want it in your paper because I think it's really, really critical. If I were interviewing with USAA, I would actually bring this up because I think it's really, really, really important to understand insurance. So how can experience lead you astray? And there's two ways. I actually talked some of this with my risk management class last night. Number one is there's just very limited history. Not much has happened. So terrorism risk and earthquake risk, they don't happen very often, but when they happen, they can be massive. So history doesn't help you very much just because they're so infrequent. We really haven't had a major terrorism risk. It depends on you define terrorism risk. I know we've had some pretty horrible shootings, but a major terrorism event hasn't happened really in the US since 9/11 in a way that the insurance industry has really, really noticed it. Does that mean we won't have another one going forward? You know, it's hard to deal with something when there's just not much history. Earthquakes, we've had a few earthquakes. The ones in California that cost the industry so much were not that major of events. It's not like some of the things we've seen in Japan and where was it here recently? Was it Indonesia or somewhere they had? I know Indonesia several years ago, they had one where they lost like 300,000 people. I think it was really, really, really bad earthquake. So we've seen them in the rest of the world. Certainly the US is exposed, but they don't happen that frequently. But when they happen, they're incredibly damaging. So that's tough. We have limited history. Should you write this risk at all? Remember this when you read page 10, because page 10, he's bragging about insuring terrorism risks. Does he have any better information than he had before? So it's kind of questionable there. So that's the first way. You just don't have much data. These are extremely infrequent events. The second way, and this is where he's talking about D&O insurance. The second way is something has changed, so that experience is no longer valid. So what examples could you give there? A lot of people like to think about homeowners insurance. Depends on what you believe about global warming and its impact. But if the world is warming, that means ocean waters are warming. Hurricanes love warm water, and it makes the hurricanes more powerful. If you believe the earth is warming and you believe oceans are warming, we're going to have much stronger hurricanes. So we haven't seen it in the data yet. We really haven't seen a huge shift in kind of hurricanes. One thing with hurricanes that's really important, unlike earthquakes, is hurricanes kill their own power. So hurricanes love warm water, but what does a hurricane do? It cools the water. So the stronger the hurricane, the more it cools the water, the more it kind of dies out itself. So that's one of the advantages, but warmer water will cause bigger hurricanes. So if you're looking at the history, but you blame the world is getting hotter, it's going to get significantly hotter, and ice caps are melting or whatever, then yeah, that historical distribution is not going to help you going forward. Now, the example he gives is D&O. Anybody know what D&O insurance is? Directors and officers. So if you wanted to make this your paper topic, you could do, we might actually use this one. His podcast. He has one in particular, on his podcast, excuse me. He has one about, no, I don't see where it is, but he has one on D&O and insurance, and it's really, really interesting. I'm going to pull some of it and talk about it in the class. Very interesting business. So what is director and officer insurance? So he's given an example of the second one. The distribution has changed. Not that you have limited historical experience, but the distribution has changed. So what is he talking about there? So when do people sue directors and officers of a company? When their stock is going up or when their stock's going down? The stock is going down, which means in the 90s, when the stock market did nothing but go up, you're not getting many D&O claims. All right, is that going to change? Then yeah, that's the wrong history. You have a history of really stable stock markets. That's not the time to assess directors and officers insurance, because people will start suing as soon as markets fall. So here's what he's saying. Using experience can be dangerous. Late in a bull market, large losses from D&O liability are likely relatively rare, but that's actually when your exposure is the greatest. You're probably going to see your biggest losses. Why? I talked about that in my risk management class last night. Reversion to the mean, right? You've had a really strong stock market. You're probably going to have a correction at some point. When stocks are rising, there's a scarcity of targets to sue, both questionable accounting and management. Management can get away with a lot. Experience on high limit D&O may look great, but that's exactly when your exposure is the greatest. As management's getting sloppy, stockholders getting sloppy, then you have something like 2008 or recession. Suddenly people start suing on D&O insurance. So that's the second type of coverage. So consequently, the correct rate for D&O needs to be based on exposure, maybe several times larger what experience it suggests. This is where he's going to look at it and say, wow, my competitors aren't charging much for D&O insurance because we just haven't had many claims. But I know as soon as the stock market corrects, and we know it will correct because we've seen it historically, this history we're looking at is not the right history we're looking at. The world is going to change. We know it's going to change. So insurers have found ways to ignore exposures. So here he talks about terrorism. You don't need this in your paper, but I found this somewhat interesting. He's saying terrorism could bankrupt the industry. So the US Congress, after 9/11, they actually provided some coverage for terrorism risk at the federal government level. And the main reason was after 9/11, no one wanted to build 50-story, 100-story buildings anymore. And Congress is like, in real estate industry saying, hey, we got to do something about this. We're shutting down our industry. And so Congress stepped in, mainly because it's just like, if this wipes out the entire industry, no one's going to come out ahead. It's just going to be disastrous. And so what does Congress say? Well, it wipes out the industry. That's bad. We can wipe out the U.S. taxpayer. That's not so bad. We'll just pass it on to them. And that's their solution. Let's just have the taxpayer take it on. We don't care, right? We'll pay anything. So here's things he says he learned. I don't necessarily agree with all of these. To see if you agree with them. He's talking about terrorism risk. The probability of another 9/11 is not zero. That's probably true, right? You kind of guess. I don't know about this second one. I actually think this might actually be the opposite. He says the probabilities are increasing. Is that true after 9/11? I'd almost say they were decreasing, right? Our government finally got serious. I mean, it's pretty amazing our government missed 9/11. They had indications there was something weird going on, and they had data, and they just, our government really failed us. He says they're increasing in an irregular and measurable manner. The advantage people that do these type of events have, as horrible as it is they have time they can wait for us to get complacent again. They don't have to act, 2 weeks later, 3 weeks later. They can wait 5, 10 years. So they do have the advantage of just knowing we're going to get complacent. So fear resides with time, but you've never won on this. So the best you can do is just a long-term stalemate. But we have gone almost 25 years now without another major event. I know you've had some events like in Europe. UK and Paris have had some major events, but not nearly as big as what we've seen with 9/11. And from an insurance standpoint, I know Paris was horrible, UK was horrible, but from an insurance standpoint, not really that big of events, not like what we saw with 9/11. There's blithely. What does blithely mean? Y'all remember? Indifferent, right? Until now, insurers and reinsurers blithely assume the financial consequences from incalculable risk. Incalculable, that's that very, very first standard. Make sure you can calculate the risk. And then he essentially says there is a scenario that wipes out the entire industry. Only the US government can possibly handle that. So I'm not sure I completely agree with this. The US government has taken over flood insurance. They manage it pretty strictly and they really limit it. So there's a lot of people, especially on the coast, that just have terribly inadequate insurance because the federal program doesn't cover that much. I don't know why people, some of y'all have family members that have a house on the coast. I mean, they're self-insuring a lot of that. Your limit might be $300,000 and you have $1 million house. I mean, you're going to be paying to rebuild that house. So the government's already taken over flood. They jumped in a little bit on the terrorism risk, but not quite as extensively as they did on the flood side. Mainly because the government, since it can print money, it can somewhat get out of these cases. We'll see in the state of Texas that there are some government programs. So Texas does have a wind pool. We'll talk about that. So if you have a house on the coast, so we'll talk about this later. So if you have a house on the coast, there's two things that can hit you: wind and water. The insurance industry covers the wind, but not the water. That's the flood side. But in Texas, we have a wind pool, so the state covers both the wind. The state covers the wind, the federal government covers the water. We'll talk a bit later about the difficulty of figuring out if your house was destroyed by the wind or destroyed by the water, because that can get really, really tricky. All right. So read the rest of this, see if any ideas come up. What I'm looking for in the rubric, first of all, that you understand this experience versus exposure. I want quite a bit there. It's not going to be 2 sentences. You need to really write that out and make sure you understand it. And then I want you to further explain it by giving me examples of the 2 things. Very limited history, or we have history, but the history is not good because things are changing. We know something's different going forward. All right. So really, really 20% of the paper is right there. Any questions up through there? Now, you can read through this section. None of this section is on the paper, but it's interesting stuff. I mean, read through it, may give you some ideas to discuss about. But top of page 10, we'll talk about this next class. But what do I want you to do on top of page 10? So we'll start there. All right, any questions on anything